Welcome to the Retirement Lifestyle Show. I'm your co-host, Roshan Loungani, here with Adrian Nicholson. Eric is out this week. Adrian, how are you doing today?
I'm doing good. Glad you're here, Roshan. Excited for today's podcast. And hopefully Eric will be back next week for another good episode. I'm looking forward to it.
Yep, as am I. I'm really excited for this one. This is one where we talked about when I was discussing research and analysis of stocks. We talked about how it's sometimes like a rabbit hole where you just don't know how long it's going to take, how much time and effort you'll have to put in. And this week's topic, we're continuing to talk about the banking crisis, which we first talked about with the Silicon Valley Bank crash back in March. And I have a feeling we'll be revisiting this. So Eric loves when we do a series. So I think this will be a series that we'll keep revisiting. The reason I think so is I think there is potentially a huge opportunity here. I say potentially because the banking world and banking stocks have really been rocked by this Silicon Valley Bank, Signature Bank, and then First Republic Bank, you know, going into receivership. And I'm I feel like there are probably some babies being thrown out with the bathwater, and I want to look for them. So today, Adrian and I will be discussing uh, how to start looking. And I've spent hours and hours researching this, and I'm still at the early stages of how to look and what to look for. So, Adrian, let's start with your list. You've got four items you're looking for, and then I'll go through
Yes, I
mine,
do.
yeah, I'll go through mine, which is four to five things, but they may or may not be the same. So let's start us off.
Okay, yeah, that'd be interesting if we have some overlap. So this is really the beginning process of looking at banks where, again, we're talking about some of these banks have really been going down right now, and people are looking for just opportunities. Which banks, as you referred to, are just being thrown out because they're all being thrown out within this category. So what I pulled today are four financial metrics that you can look at if there's a bank that you're interested in when it comes to investing. And it does take a lot of research. People can really spend a whole day looking at a bank and seeing whether or not they should invest in it or not, and really not come to an answer. But I'm going to be going over certain definitions and examples with these four financial metrics to give you really a starting place where it comes to a particular bank that you want to invest in and you don't really know where to begin with. So the first financial metric I want to talk about, I'm sure you're aware of this one, Roshan, is return on equity. This is a financial metric that measures, in this case, a bank's profitability and efficiency in generating profits from shareholder equity invested in a bank. So, how much profit a bank can generate for every dollar of shareholder equity that is put in. And this is a really good one to start off with because it's really just a metric that you can look at historically that a bank's done to see if they've really been consistently profitable. And I think that's a really good place to start. And I broke down five different sections on return on equity and why it's important. What do you think of this one so far, Roshan?
The first one on my list as well, is return on equity. And return on equity, as you said, is the what the investor will get, what in terms of their return in theory. And uh, Munger's got a quote, Charlie Munger does, that over the long term, a business will return what the business will return, what the stock will do will follow its return on equity. So theoretically speaking, if you've got a return on equity of 10%, that stock should grow at 10% a year. So I'm at the same
Exactly.
place. Yeah.
And that's one of there are actually four sections that I broke down return on equity and why it's important. And you just touched on one. That one is investor return, where the higher return on equity really shows that there's an increased potential for the shareholder to receive higher returns on their investment in this bank. And that's what we're trying to note here. And there is an increase in chances of higher earnings in the future as well with the invested capital that you put in. The next one is within the return on equity umbrella is profitability, the main one that we just touched on, where this bank is generating more profit for the money invested by shareholders. And this really shows that the bank is being efficient in utilizing the resources when it comes to generating earnings. And that's something that investors are really looking at today with higher interest rates, companies laying off people, the markets and companies are just getting a lot tighter and more competitive, where people are really they're allocating their money to companies that are really being efficient with and having a really strong business model in this tough economic environment. The
Yeah,
next one for yeah,
hold on.
go
I
ahead.
just want to add in. We're on the same page today. You were going over a term that I was going to use. That sometimes return on equity will be in a group of other calculations or ratios that are either categorized as profitability or management effectiveness.
Mm-hmm.
So, and we're going to go over multiple criteria, so you can't rely on just one. I'm not actually sure if I could even find out what Silicon Valley Bank or First Republic's return on equity was before they went under, but I
Mm-hmm.
imagine they had decent numbers there. So it's not just about what it was. You've also got to look at what the company's doing, in this case, what the bank's doing, to see, do you think that it can continue down that path?
Mm-hmm. Yes, and it's also a good way to compare as well because there's companies whose stock prices are down right now, especially these banks, and using return on equity as a comparison is a good starting point as well, where you're seeing which companies are more profitable, which ones are more efficient with the money that they're getting in the door. It really can help highlight which regional bank or what bank is more attractive for you to start investing in or beginning your research in, whatever it may be. And then
Yeah,
the
and
last one, yep, go ahead, Roshan.
I just thought that was a good time to add our required and important disclosure that this is all for looking into ideas and concepts and research. This is not investment advice by any means. We're just looking at the banking crisis and thinking there may be an opportunity there. So let's start digging. And I can tell you, we're really at the early stages of doing our research as it is as well. So please, Adrian, continue.
Yeah, and we hope that you gain some valuable insight on how we really begin our research by giving you these metrics where you can start. Just sometimes we touch on do your research, do your homework. Well, we're really giving you a guideline on how you can start that here. And I really like where we're headed right now. And the last one, which we touched on, is just the risk assessment with it. As we mentioned before, which isn't always the case with future, a consistently high return on equity may indicate that there are proper risk management practices in place and there's a strong business model where they're really converting every shareholder dollar into earnings. And that's really the name of the game when it comes to investing.
Yeah, and you had mentioned a risk model and in that, and I think that's what Silicon Valley Bank showed was so important, right?
Mm-hmm.
When you look at it, and I don't remember the exact quote, but Yellen came out and said something to the effect of it was a textbook case of poor management. And I think part of
Mm-hmm.
it was the risk they took. It's been very well documented that they did not have a chief risk officer. So I I completely see that risk and looking at that risk as being one of the major points. It could deserve a category of its own with how they're managing risk.
Mm-hmm. Exactly. Are you ready for me to move on to my next one then?
Yes, let's do that.
So, my next financial metric when it comes to looking and researching at banks, this one might be a new term that some people may not be familiar with. It's called net interest income. And this is a dollar amount of income a bank earns from its core lending and borrowing activities. This is measured by a bank's revenue generated from the interest it earns on its assets minus the interest expense it incurs on its interest bearing liabilities, such as deposits and borrowing. This is a really good one to look into if you're looking at banks because this also is a good indicator on profitability as well. And it gives you an absolute measure on a bank's revenue from a core operation standpoint as well. with a higher interest income, this can show that there's really strong revenue being generated from a bank. And that's really good now on what we talked about earlier, how with this economic and market environment right now, people are really looking for, especially in banks' cases, stable banks that have consistent earnings. So net interest income is really important here when it comes to looking at banks and investment.
Yeah, that's their bread and butter. And I think when you look at that net interest income, I wouldn't just look at it at one year. Looking at
Mhm.
it over time, I think is important to see growth. And then second, as I had said earlier with that return on equity, you've got to understand the business, what the bank does and what business they're in and focusing on to see if that'll continue. So we keep going back to this Silicon Valley Bank example because of what happened, but their business was primarily related to startup companies, right? So we enter an environment where these startup companies aren't raising capital as fast as interest rates go up. And those types of businesses like that venture capital business and so on tends to do a lot more activity at the top of an economic cycle, and things have slowed down. So if you were looking at any bank, well, what business are they in? And you'll find when you think of a bank, they're in general viewed as plain vanilla businesses, which they kind of are, but you do have them focusing on different areas. I was looking into one recently, and I didn't realize this. As I said, we're in such early stages, so I'm just trying to understand the different business models. But when you get into their annual reports, you can see, well, okay, they focus on, and this specific one was on healthcare, and just
Mhm.
without it's right there in black and white in the annual report, but you don't really see that unless you go get the annual report and look for the information.
Exactly. Just digging deeper on what they provide for you is the name of the game when it comes to researching these banks as well. And I'm going to move on to the next one because that has some overlapping correlation with the one I just talked about. This one is net interest margin, and this is a profitability ratio. And this is basically net interest income as a percentage of a bank's average interest that it earns on its assets. And this shows a spread between the interest earned and the interest paid out relative to the size of the bank's earning assets. And this is a way that you can compare and contrast between different banks and their sizes, because when you look at just net interest income on its own, you're going to see a big difference between, let's just say, a big bank compared to a small bank. Where if you just look and compare on a net interest margin, a profitability ratio, this can highlight a bank that is more efficient. And that's something that people are really going to look at when it comes to investing, because it's not just about generating a lot of money, it's about efficiency in some cases when you're looking at investing.
Yeah, and Adrian, this was not on my list. The net interest income wasn't on my list, but just in the nature of what they do, it's
Mhm.
something to look for. And so this is a good one. I'm actually going to read out the formula because I looked it up exactly as you said it. But it's uh, investment return uh, minus interest expense divided by average earning assets. So
Mhm.
how much their overall asset base is. Another thing you see or I've heard a lot or read a lot about is they'll talk about the banks and the cost of their deposits. So if you go online and search for the best rates on and you'll see a bank offering a better rate than another bank, well, that means their deposits are expensive because they're giving you the saver a higher rate than the other banks are. So some of the bank's business models, as I mentioned earlier, will focus on let's attract these depositors by paying them higher rates, and then they'll lend to earn money. But at the end, they may be attracting a lot more capital, but they might not earn as much as a bank that has less capital but is paying less to their depositors.
Mhm. Yeah, that's a really good point. And ultimately, when it comes down to this as well, while net interest income measures just an absolute income on a dollar for dollar basis, net interest rate margin provides that relative measure that people are looking at where it shows how effective a bank can maintain its profitability, especially in different interest rate environments as well, because that's what you saw was an issue with Silicon Valley Bank and all these other banks with interest rates decreasing. A bank with a stable and sustainable net interest margin can be more attractive, especially if you're an investor for the long term and you're looking for long term opportunities in this case, because that's what it shows you. It shows you that this bank is very profitable and it's been sustainable and it's really making use of all the dollars that are going into its business model as well. So that's something to keep note of and really add to your tools of research as well when you're looking at banks.
Yeah, agreed. What's next on your list?
So the last one I have, and I really just want to take it off this list and really not cover it, but I might as well at this point because when I really dug into this metric, it was very complex. But I'm going to talk about it as well because it's really important when it comes to looking at banks. This is called the capital adequacy ratio. And this takes banks' total capital divided by its risk weighted assets times 100. It's a ratio. And what ultimately this shows is how much money does the bank really have, its assets, and you're dividing it by the risk associated with its investments. And within each of this numerator and denominator, the numerator being the total capital and the denominator being the risk weighted assets, are different tier levels. Because as we know, banks are very large, they have different assets and investments in them, where this is really looking at not only how efficient the bank is, but really comparing its assets to the liabilities on a tier level system to see if the bank can withstand certain economic downturns or unexpected situations. And that's why I want to talk about this financial metric as well, because that what I just mentioned is extremely important. Can a bank withstand unexpected situations? And how will it respond to economic downturn right now? And that's why I think it's really important for us to discuss this and maybe look into it a little bit further going in the future, because that's something that people need to consider whether they're allocating their dollars for investing, especially when it comes to a bank. How will this bank respond to complex obstacles in the future?
Can you repeat the title and the definition of that ratio one more time?
Yeah, the capital adequacy ratio. This is total capital divided by its risk weighted assets times 100.
And I'd be, did they talk at all about what define that risk weighted assets, how that's defined at all?
So this is actually different between banks because there's a lot of regulatory frameworks that are involved here that might be different from one bank to another bank. But some of the components may vary and are different, but it's based on the loans that the bank has, based on common shares, retained earnings, preferred stock. It really just varies depending on the bank size as well, because there are a lot of assets and liabilities based on the bank's different sizes. But the tier levels I haven't looked farther into because, again, once I started really looking at how complex this metric is, I thought just going over the basic definition before I look further into it.
Yeah, I appreciate what you've come up with because it's added to my list. We only really had, I guess I'd say we had overlap on two of them. One of
Mhm.
them I didn't write down just because, but it would be something to look at. So I think it's very helpful to have that clearly written out. I'll go with what I've got
Yeah, and
on
again,
my list.
ultimately, I just brought it up because when I saw the definition, it basically said this metric is extremely important because it shows whether a bank can withstand hard times right now and
Yeah.
unforeseen circumstances. And that's something that investors are very concerned about right now because this market really can be unforgiving for certain businesses, especially in banks' cases that aren't structured in the right way, especially when it comes to its assets right now. So that's why I thought it was at least worth sharing for our listeners and viewers today to look more into if they're deciding between certain banks.
Yes. There's so many banks available, and there appears to be such a big opportunity that I think everything you can add to feel more comfortable before you make a decision, all these different metrics um, are useful to get you going. and making that decision. I'll go over what I've got next. And we've talked about this on previous episodes. What I'm looking for is how to manage time. And it's not in order to make a quick decision, it's in order to make a well-researched decision. So looking for where to allocate your time because there's so many banks out there. So what I have next on my list, I added your two of yours, Adrian, but I had return on equity, and my next was current valuation. And the whole point of current valuation is if I'm going to dive deep in this company, I'd like to know at the starting point that it does appear to be a cheap company from a investment perspective, from an investment perspective, so that my time is well spent here. So this is a quick one where I was really looking at the basics of either like a low PE ratio just as a starting point. But remember, before I went to the valuation, my number one starting point was return on equity. So I want a bank that has a history of a good return on equity uh, to start. And then later on, when I get deeper into my research, as I'm getting deep into the individual company, which once again, I haven't really started that part yet. I'm still at the bigger picture stage. But once I get into the deeper into the individual company, I want to I want them to have a good return on equity. So, which to me is a starting point to defining a good business, and I want it selling at a good price, which is where valuation comes in.
Yeah, and you mentioned the PE ratio for people that aren't familiar with that. That's price versus earnings, price divided by earnings, and that's a good starting point to see how a company is valued versus the price that the market is giving that day for a particular bank. It's a really good starting point. I like how you're combining. That's the name of the game here, combining different tools, different metrics, and just trying to see what the picture is, because that can really outline and show you and help you when it comes time to make a decision if you come to that case.
And to compare this PE ratio number, the market, being the S&P 500, is at roughly a 20 PE ratio, and there are multiple banks trading for PEs under 10, and there's a lot out there that are trading at PEs, uh, i- i- I'd say between 5 and 8. So
Hmm.
you are seeing this is why we're covering this, right? We're looking at the banking crisis saying, okay, there's an opportunity there. Now, there's definitely risk as well, right? That's where why the opportunity is there is because there are banks that are closing down and there are banks going into receivership. We mentioned three today, with Silicon Valley, Signature, and First Republic, and there are probably going to be more, right? So that's why you're seeing these lower valuations. And I use the phrase throwing the baby out with the bathwater, and that's what we're looking for, those good investments out there that are just being thrown out because banks are in general.
Yeah,
Now,
and there's another phrase I like, don't try and catch a falling knife. That's where maybe a certain bank or a company, its stock price is going down, and you think that it's a good level to maybe get in and start buying. You did your research, you think this is a good opportunity, but they're really continuing to go down, and maybe you missed something that really would have deterred you otherwise from making that initial investment. So I thought that was another phrase worth sharing as well that people just need to be aware of.
it is, and all this research and analysis is to avoid that, right? You don't want
Mhm.
to catch a falling knife. You don't want to find a bank. And a lot of times when I've seen that happen or seen people do it, what their thought process is this was selling at, $20 or $30. Now it's selling at 10. Let me buy, right? And we're hoping that by having by sharing with you a more defined, well thought out process, doing greater research, uh, you're not making your decision on price movement. You're making your decision on quality of the business, quality of the
Mhm.
bank.
Yeah, and I just want to share another phrase that I heard as well, but I'm not sure if this is more of a market phrase or an individual company phrase, especially when it comes to price. It's called dead cat bounce. That's a new one that I heard actually this week. Is that more for a market or an individual company? Are you familiar with that phrase?
I am, and I think it could be either. So, do you want to define it for everyone?
So I actually haven't looked into it. I heard it, but I'm assuming it's, I guess something's going down and then it bounces up for a little bit only to just go back down.
Yeah, and I'd want to look up the etymology of it, where it came from, but essentially, if a dead cat drops and hits the ground, it'll bounce up right before it drops again.
It's pretty morbid, but again, it's just
Yeah,
a way for people to, I guess, have like a learning lesson going for it. So I guess it does have some educational purposes.
yeah, and in this situation, what we're talking about, that dead cat bounces would be a temporary increase in share price. So going back to what you had said about catch a falling knife, that's the stock price was, let's say, at 25, it drops down to 10, it goes up to like 11 or 12, and then it drops back down again, right? So
Mhm.
sometimes people will look at that dead cat bounce and say, okay, this is the bottom, let's buy. But once again, that's based just on price action, just based on the price going down. So that's why we want to add all these additional tools for you and share all this additional information so that you can research it and not either catch a falling knife or mistake a dead cat bounce for a bullish move on the price.
Mhm.
So I went over valuation. The next one I would look at is deposits at risk. Now, deposits at risk, what happened with Silicon Valley Bank and what can happen extremely quickly now is a run on the bank, meaning people go in and they pull their deposits out quickly. So what what you can do to look at to try to avoid that situation. Oh, let me explain further. One, people can do it quickly if pull their money out. That's a lot now because online banking makes it so easy. You know, before, if you look back or Google it or look at old pictures, there are people waiting in line at banks to withdraw their money. You don't need to wait in line anymore. You go online and with some clicks, you can pull money out. And I don't remember the data. Please check that Silicon Valley Bank episode that we had because we had the numbers there. But I think something like a half or a third of their deposit base went out in a day, right?
Wow.
So you want to make sure that any bank you're looking into, their deposits are safe. So if you can look at some data to see if money's been coming into the bank or taken out, you can look at their reports. But the most recent quarterly report will be the first quarters, as of March 31st, and the banking crisis started really in March. So you might have to keep digging for additional information. Another thing you can look at to figure out this information is, or at least to put the odds in your favor, is you can easily, with a Google search, find out what percentage of their deposits are uninsured, meaning what percentage of their deposits are over $250,000. So if you're a depositor and you've got $250,000, you're covered with FDIC insurance. If you're above 250, you're not. So the people above 250 are more likely to move their money quickly because if they're worried about a bank failure, because they're not insured. So Silicon Valley Bank, they had 93.8% of their deposits uninsured, which was the highest out there. Signature Bank, which also went under, was fourth on the list with 89.3% of their deposits uninsured. First Republic Bank was further down the list at 67.4% being uninsured. Now, I don't have a safe number, right? So that's something you've got to research and look into as far as what level of uninsured deposits is acceptable or okay. But there have been banks on the list at the 50% level that people have been betting would fail. And I'm not saying that they will or that they won't. It's just sharing data and research that we have. So my next point was what deposits are at risk. After that, I read a lot about the risks in commercial real estate. So I'd want to see what I can find out about their commercial loan portfolio to see how much is at risk there. So the situation
Is the
with
majority of that issue just people aren't coming back into the office, or is there something deeper going on with the commercial real estate, or is it really just company specific right now? Companies are just cutting back on how much real estate they really need to run their operations.
So I think it's both. That's a very good question. I think both in the sense that I think they're related, right? You've got people going into work to the office less, post COVID. So
Hmm.
corporations don't need the office space as much, so uh, they can have a smaller footprint in terms of commercial real estate, which leads to high vacancy rates, which could potentially lead to defaults, right? And if you're a bank holding a default, commercial real estate is uh, is always priced, or I should say, is usually priced pretty soundly, where they're just saying, here's what your rental income is, and they will take that rental income, and they'll have a cap rate. What percent are you getting, right? So the if the building's full and fully rented out, then it'll sell for more. If there's less people renting the building, it'll sell for less. So if you're a bank, you've lent money to a company to buy a commercial property, and it was fully rented. Well, they bought it for a high price. Now it's at 50% occupancy. Well, theoretically, the price has been cut in half because it's only at 50% occupancy. So if you, as the bank, let's put numbers to this, you gave someone a $10 million loan to buy a building that's, let's say, worth 15 million. That building is now only 50% occupied, so it's not worth 15 million anymore. It's worth 7.5 million. Well, now as a lender, you will take the building over because the borrower can't pay you, and you have a loan outstanding for 7 million, but I'm sorry, for 10 million, but it's only worth 7.5. So that's the risk with commercial loan portfolio. And I have not gotten far enough to figure out um, how to define this. It'll definitely be a company by company thing. And I'm still at the stage where I'm looking at the industry and what to look for versus looking at individual banks. So that's why I had mentioned at the beginning, I think Eric will be very happy. This will turn into a series, considering we've gone over Silicon Valley Bank. Now, a couple months later, we're going over, well, are there opportunities? And I think we'll continue down with what we found within the guidelines of the industry and compliance. We'll share what we can. Um, Another piece I have on here is how much of their capital is invested in held to maturity loans. Now, held to maturity loans are loans where they don't necessarily have to mark them to market. So they don't have to lower the value if the value's gone down, because they'll hold it to maturity. This is used a lot for treasuries. So if a bank owns a 30-year treasury or a 20-year treasury, those have declined by 20 to 30% last year. So, and once again, this goes back to Silicon Valley Bank. They had a lot of their capital in the held to maturity securities. While those values have gone way down, and they have money being pulled out, which led to their failure. So I want to look at it as uh, how much of their portfolio, their investments are in that held to maturity category. That's also an easy one to find just in their annual report.
Is this also driven by what the Fed does? Because I gotta assume that just depending on how long your research is, you have the Fed and what they're going to do far as rates in the back of your mind, because that decision really, I gotta assume, impacts this to a certain degree, right? Or could it be something else?
No, it definitely does, and many people blaming the Fed for the Silicon Valley Bank thing, saying they raised rates too quickly, and that's part of what caused them to fail, because their held to maturity securities declined so much in value. And once again, they didn't have to report a decline. So I'm trying to find out, well, what are they holding it for, and how much of their portfolio is it, to see if that risk is if that's a risk that could be associated with this bank. And any of these things, if they don't, as I mentioned, I don't have a specific number or a specific percentage or anything like that in mind yet. But if they fail any of these tests, that would tell me, okay, I've got to move on to another one. So I'm looking for a bank I feel comfortable passing all of these tests. And I think they're out there, as I said. But using Adrian's phrase, I don't want to catch a falling knife. So I want to make sure. I'd rather not put any capital in this space than to catch a falling knife.
Hmm.
Um, After that, next I've got on my list is the dividend safe. And typically people will look at what percentage of their earnings are they distributing as a dividend. I want to look a little bit deeper and further into that with each of these banks, because if a bank will cut its dividend, their stock price will likely drop even further. So I want to make sure that I don't think the dividend is being cut. I think they're safe and they can keep operating and keep paying the dividend. You can get really good dividend yields right now on banks, but I can't tell you the historical average. Have not looked that up yet. But you're getting banks. There are banks out there right now that are yielding like 9%. Yeah, they're and higher, which is ridiculously high for banks. Now, if the bank survives and they can keep paying that dividend, you're getting paid 9% while you wait. If that bank goes under, you could lose your entire capital, right? So that dividend is meaningless if you lose all your money. So I want to make sure the dividend's safe, not just because I'm counting on the yield, but because I think the stock price will drop if the dividend is cut. Even if they stay in business, cut the dividend, I think the price goes down. Now, after that, on my notes, I've just got another category, which is banks I need to research and why. So, on my research so far, there's 7 names on the list right now of banks I want to look into further that, as I mentioned, I have not looked into at all yet. And there are various reasons behind it. They're actually, I haven't looked at them. I haven't done a screen of, give me those high return on equity, low PEs yet. So that's another thing that'll expand that list as I research it. The list I've got right now of 7 names is just based on what I've read and what I've researched so far. And in addition to that, I also liked, and this is a criteria worth considering. I also like looking at our insiders buying. Right. So that's my list of 7 consists right now of 2 that are driven by insiders buying and 5 that have just been through my various research and articles that have been recommended by other sources. So I don't know which one I'm going to start with yet because I'm still looking at the industry as a whole. I'm going to recap our list, and then we will be back with an update in the future. But the list was Adrian's list was return on equity, net interest income, net interest margin, capital adequacy ratio. Then mine added onto it current valuation. What's the valuation right now? The deposits at risk, commercial loan portfolio at risk, uh, how much of their capital is in held to maturity loans, and is the dividend safe? So I think with those 2 combined, we've come up with a list of 9 things to start your research if you're looking into this sector, which we're covering because we think there's an opportunity there. Adrian, do you have anything you'd like to add?
Nothing to add right now. I really like the list. Like you mentioned, it's just a really good starting point to begin where to look.
Yeah. And on your quest for opportunities and growing your capital, I think this is a good starting point. We're here to help. If you need help, reach out to us. Thank you for listening. Please like, subscribe, give us 5 stars, tell your friends and family, and we'll be back next week for another episode of the Retirement Lifestyle Show.